Welcome everyone to our deep dive into the breakout trading strategy. This is widely considered one of the most powerful strategies available for both swing and positional traders. Breakout stocks are highly sought after because they often exhibit incredibly fast and aggressive momentum, allowing traders to capture significant market moves in a relatively short amount of time.
However, it is vital to understand that this rapid momentum comes with a catch. Breakout trading is exactly where the highest number of market traps occur. This is not some minor, insignificant concept. There are countless professional traders who rely exclusively on breakout setups, and they are doing exceptionally well by mastering these specific patterns.
Before we can fully grasp how breakouts work, we first need to establish a solid understanding of simple support and resistance. Every single place chart has these critical, invisible levels where the market reacts. These are the foundational building blocks of technical analysis, dictating where price action is likely to pause, reverse, or accelerate.
Let us start by looking at the support level. You can think of support as a floor where buyers become highly active. Because there is a strong concentration of buying interest at this specific price point, the falling price tends to bounce upward, struggling to drop any lower than this established foundation.
On the flip side, we have resistance. This acts as a ceiling where sellers become highly active. When the price rallies up to this level, buyers who entered at support often take their profits, and new sellers step in. This combined selling pressure causes the price to be rejected and pushed back down.
So, in simple terms, a breakout occurs when the price forcefully pushes through and breaks one of these highly important chart levels. Identifying a breakout on a chart is actually quite straightforward. You are essentially looking for the exact moment the price escapes its historical boundaries and ventures into new territory. A crucial factor here is trading volume. If the price breaks past a historical selling zone or resistance and does so with a massive surge in volume, it strongly indicates that the price has the momentum to go much higher. This makes a high-volume breakout a nearly perfect entry impression for observant traders.
Now that you understand the basic mechanism, let us explore the different types of breakouts. When a market or a specific stock is just bouncing around within a tight horizontal range for an extended period and then suddenly breaks out of that range, we call this a consolidation breakout. This sideways movement is often referred to as the accumulation phase, where smart money is building positions. If the price breaks the upper resistance, it is a bullish consolidation breakout. Conversely, if the price drops below the bottom support level, it is technically referred to as a consolidation breakdown. The next major category is the trend breakout. Markets usually follow a specific trend over a given time period. In an uptrend, the price is moving in an upward direction, consistently creating a staircase pattern of higher highs and higher lows as it climbs the chart. However, trends do not last forever. Exactly when the price fails to hold its upward momentum and breaks down below the established support line of that uptrend, we witness an uptrend breakout, which is more commonly and accurately referred to as an uptrend breakdown. Now, let us look at the opposite scenario, the downtrend. As you might guess, a downtrend is characterized by the price making continuous lower lows and lower highs. Traders will typically connect two or more of these lower highs to draw a descending trend line, visually mapping the downward pressure. The price will respect and follow this downward trend line for a certain period, but eventually the buyers will overpower the sellers, and the price will break above this descending line. This specific event is known as a downtrend breakout, signaling a potential shift from negative to positive market sentiment. So, we have covered the foundational concepts of moving from uptrends to downtrends and escaping sideways accumulation zones. These are the basic mechanics of trend and consolidation breakouts. But the most important topic is yet to come. How do we actually confirm a breakout is real and not a trap? Moving right into how we handle breakouts, we have to acknowledge that not every breakout is real. If they were, every trader would be highly profitable. In reality, markets present both real and fake breakouts, making confirmation an absolute necessity before risking any capital. The first metric to check is volume confirmation. When the price breaks a swing high or a resistance level, the trading volume needs to be aggressively high. High volume indicates that both buyers and sellers are active, but buyers have ultimately taken control, meaning the price can sustain itself above that resistance. Conversely, if you spot a breakout but the volume is barely moving, you are likely looking at a fake breakout. Without that strong buyer momentum pushing the volume up, the price is highly susceptible to falling right back down below the resistance level. Our second confirmation tool is the retracement after a breakout.
Sometimes the price breaks resistance with decent volume, but then it pulls back to retest that exact same level before moving higher. This is a crucial moment where the old resistance must successfully act as a new support level. Seriously. Next, we look at timeframes and candlestick confirmation. Many beginners jump in as soon as they see an hourly breakout in the live market. However, you should use the hourly chart for entry timing, but always rely on daily or weekly timeframes to actually confirm the trend. If you don't wait for the candle to close, you might get trapped. If the candle closes below the resistance level, it means the price couldn't sustain its upward momentum. A pullback is highly likely, which is why waiting for that final candle close is a mandatory step. Now, let's discuss entry and exit strategies, specifically starting with the consolidation breakout. In this scenario, the price is playing within a tight range. You have sellers consistently active at the top resistance and buyers stepping in at the bottom support, creating a prolonged sideways movement. To make your resistance mapping more effective, don't just draw a single line. Instead, draw a rectangular zone that covers the previous closing price and the small last selling candle. This gives you a much more accurate threshold to monitor for a potential breakout. So, what does a perfect breakout setup look like? First, the price breaks out with aggressively high volume. Second, the candle closes decisively above the previous high. Finally, the next candle performs a retracement, retesting the level and confirming it as support. That is your entry signal. When you enter on that retracement, your stop loss should be placed just below the last selling candle of that swing, keeping your risk to a minimal 4%. For your target, you can look at historical chart highs or use Fibonacci extensions to determine where to take profit. There is also a bonus strategy here for consolidation zones. You don't always have to wait for the breakout. You can buy exactly at the support zone and set your target for the resistance zone. Your stop loss goes just below the support level. When the price reaches that resistance zone, you take a partial exit to secure profits. Then you simply hold the remaining position and wait. If a confirmed breakout happens, you can add more quantity back in, significantly lowering your overall risk profile. Let's look at a real-world example of a fake breakout using a major index level. The market breaks a significant resistance, like the 2800 mark, with high volume. It looks perfect. But during the retracement phase, it completely fails to hold the level, and the fall continues. Moving on from consolidation, we have the downtrend breakout. In a downtrend, the price is continuously making lower lows and lower highs. We map this by drawing a downward trend line connecting two or more of those lower highs. Every touch of this line is normally a sell opportunity. But the dynamic shifts entirely when the price finally breaks through that downward trend line. This is your downtrend breakout. Just like before, when you take an entry here, your stop loss must be placed below the last selling candle to protect your capital before we even think about risk management. Moving right along, we must address the most critical element in trading, risk management. Many beginners focus entirely on potential profits, but trading success probabilities are often less than 50%. Before even thinking about gains, a trader must be prepared for the maximum acceptable loss to ensure long-term survival. The first step is defining how much capital to allocate per stock. For instance, with a 10 lakh capital, dividing it equally across 4 to 5 stocks reduces exposure. In swing trading, aiming for a 3 to 6% risk requires a minimum target of 6 to 12%, strictly maintaining a 1 to 2 risk-to-reward ratio. Stop loss placement is typically set manually just below a support or selling zone. If the price breaks below this level, exiting the trade is mandatory. Many traders struggle here due to the psychological hope that the price will recover, but failing to exit usually leads to much larger losses and trapped capital. On the flip side, when a trade moves favorably and hits the target, it is wise to take partial profits. By exiting 50 to 70% of the position, the trader secures gains regardless of market rumors. The remaining quantity can then be held using a trailing stop loss to safely ride further upward momentum. Let us look at a practical chart scenario. In a standard uptrend, the third touch of a trend line usually acts as support. However, what happens when the price does not respect this support and continues to fall? Entering a trade here requires a highly calculated accumulation strategy rather than buying all at once. Because a single green candle only indicates potential reversal without confirmation, one should never invest their entire allocated capital at once. A staggered approach is much safer. For example, buying 50% of the intended quantity at the initial level, then adding 25% at the next support, and the final 25% lower down.
By accumulating in stages during a dip, the overall entry price is significantly lowered. Using a weighted average cost of capital calculator, entering at multiple lower stages brings the average cost down substantially. This makes reaching profitability much easier and faster when the price finally bounces back from the lower support zones.
Once the price begins to reverse upward, setting realistic targets is the next step. A fundamental rule of technical analysis is that a broken support level often flips to become new resistance. Therefore, the immediate primary target should be placed right at that previous support zone, where selling pressure is expected.
If the price breaks through that primary resistance with strong momentum, advanced tools like Fibonacci extensions help identify further targets. By mapping the swing high to the swing low, levels like 1.414 provide logical exit points for the remaining held quantities, as we prepare to look at specific trade executions next. Let's address market extremes. It can be incredibly tempting to jump in when a stock price is continuously skyrocketing, driven by the fear of missing out. Conversely, trying to buy when an asset is in a continuous steep freefall is equally dangerous. Neither of these extreme situations is typically a suitable time to initiate a buy position without a clear plan. When you buy into a vertical ascent, you are often buying at the absolute peak of market euphoria. The risk of a sudden correction is massive, and emotions, rather than logic, are driving the decision. Similarly, buying into a continuous fall is like trying to catch a falling knife. Without waiting for consolidation or a clear reversal signal, you expose your portfolio to severe, uncalculated drawdowns. To navigate these market movements, we have to meticulously manage our capital. This means deciding exactly what percentage of your portfolio to allocate at specific price levels. It is never just about buying. It is about scaling in strategically and, most importantly, always having a predetermined stop loss in place to protect your capital. The stop loss is your ultimate safety net. It removes the emotional burden of deciding when to cut a losing trade. By defining this exit point before you even enter the trade, you safeguard your account from catastrophic losses. Ultimately, the what of your trading plan must be rigidly defined. You cannot rely on intuition. You need a concrete buying strategy that dictates your entries and an equally clear selling strategy for your exits. Furthermore, your profit targets and stop-loss levels must be calculated and locked in before execution. Once these four elements are clearly defined and understood, you transition from gambling to methodical trading. This structured approach is the foundation of long-term consistency in the markets. To wrap up our comprehensive look at trading systems, remember that success hinges on discipline. Avoid the emotional traps of chasing runaway prices or catching falling knives. Strictly manage your position sizes and always use stop losses. Defining your exact buying, selling, and risk parameters is what ultimately builds the psychological fortitude required for long-term market survival.